Hi looters, welcome back to Tick to Loot market updates for August 13th, 2026. Quick heads up, this video is for educational purposes only and is not financial advice. Markets carry risk. Always do your own research and consult a licensed financial advisor before making any trading decisions. Today we'll dissect yesterday's key releases, walk through today's calendar, and tie the latest headlines into the bigger picture. Let's jump right in. Let's start with what happened yesterday. In the Eurozone, Germany's final consumer price index came in exactly as expected at 0.8% month-over-month, matching the prior reading. That steadiness kept inflation expectations in check, which often supports the euro when the data aligns with forecasts. Across the bond market, Germany's 30-year auction was priced around 2.9% versus the previous 3.64%. Indicating strong demand for long-dated euro area debt. In Canada, building permits rose to a modest 0.8% month-over-month, a swing from a minus 1.7% decline, hinting at a tentative rebound in construction activity. On the U.S. side, core CPI was slated to rise 0.2% after a flat month, a figure that markets were watching closely for any sign of persistent price pressure. Finally, Japan's preliminary machine tool orders data was missing, but the low-impact label suggests limited market movement. Overall, the mix of on-target and modestly better-than-expected numbers kept major currencies relatively stable yesterday. Why does that matter? When German inflation hits the forecast, it removes surprise from the euro area price outlook, often limiting euro volatility. The lower yield on Germany's 30-year bond points to continued appetite for safe-haven euro assets, which can bolster the euro against the dollar. Canada's uptick in permits can lend modest support to the loonie, especially if the housing sector stays on that trajectory. In the U.S., the anticipation of a 0.2% core CPI rise kept the dollar under a subtle pressure as traders balanced the prospect of tighter policy against a still moderate inflation environment. And with Japan's machine tool orders yet to be released, the yen remained in the background, waiting for fresh data. Moving to today's calendar, the first high-impact item is the United Kingdom's monthly GDP for August. The forecast is a flat 0% change, down from a 0.1% rise in the previous month. A stagnant month-over-month figure could signal a slowdown in the UK's recovery, especially after the recent easing of inflation pressures. Traders will be watching the number to gauge whether the Bank of England might keep rates steady or consider a shift, since GDP growth, or the lack of it, feeds directly into monetary policy expectations. Next up, the medium-impact preliminary quarterly GDP estimate. The market expects a 0.4% rise this quarter, a slowdown from the 0.6% growth reported last quarter. A lower-than-expected quarterly pace could reinforce concerns about a tepid domestic demand environment, potentially influencing the pound's direction as investors reassess growth momentum. Even though it's a preliminary figure, analysts will compare it to the forecast to spot any emerging trends. Now for a low-impact but still relevant release. UK construction output. Forecasts point to a minus 0.3% decline month-over-month, an improvement from the minus 0.8% drop seen previously. A narrowing contraction suggests that the building sector may be finding some footing, perhaps due to easing material costs or modestly improved financing conditions. While the headline number won't move markets dramatically, it adds a layer to the broader picture of UK economic health. The next low-impact data point is the UK goods trade balance, forecast at a deficit of £20.6 billion, slightly wider than the prior £18.7 billion. A larger deficit can weigh on the pound by indicating that more money is leaving the economy for imports than returning from exports. However, because the change is modest and the services sector dominates UK trade, this figure is generally a background factor rather than a headline mover. Lastly, for today's UK lineup, the index of services growth over the past 3 months is expected at 0.5% month-over-month, down from 0.7% previously. Services make up roughly 3/4 of Britain's economy, So a slowdown here could reinforce the narrative of a softening recovery. Analysts will compare the actual reading to the forecast to see if the services sector is losing steam faster than anticipated. Switching gears to Asia, Japan's July Producer Price Index jumped 7.2% year-over-year, just shy of the 7.4% forecast and a touch above the 7.1% prior reading. Month-over-month, the increase was a modest 0.1%, well under the 0.6% expected. The strong year-over-year rise signals that wholesale price pressures remain high, but the muted monthly figure suggests a slowdown in the pace of cost growth. Markets often interpret a lower-than-expected monthly move as a potential easing of inflationary pressure, which could influence the Bank of Japan's policy stance and the yen's trajectory. Putting the German CPI into a broader Eurozone context, the on-target 0.8% month-over-month reading keeps the inflation narrative steady, with the European Central Bank still focused on bringing inflation back to its 2% goal. A consistent CPI reading supports the current monetary policy path and reduces the likelihood of surprise rate moves. Traders keep a close eye on whether any deviation appears in other member states, but Germany's data this week suggests stability. In Canada, the building permits figure posted a 0.8% rise after a 1.7% drop, hinting at a tentative rebound in housing activity. While the number is still modest, it can act as an early indicator of future construction spending, which feeds into GDP growth. If the trend continues, it could lend a supportive backdrop for the loonie, especially if other domestic data points align. That wraps up today's market snapshot, looters. To recap, we saw steady German inflation, a modest bounce in Canadian permits, and a suite of UK data that could shape the pound's near-term narrative, while Japan's PPI reminds us that producer price pressures remain elevated. Remember, this analysis is educational only and not financial advice. Hit the subscribe button for tomorrow's update. And as always, keep your research sharp and your risk management tighter. See you next time.